This episode of Startup Project is brought to you by Bear.tax. Bear.tax compiles all your crypto transactions and makes it easy for you to file your taxes. Check out Bear.tax, that is BEAR.tax, Bear.tax. Hey Sajid, welcome to the show. Thanks for taking time.
Thanks, Nataraj. It's a pleasure.
So I'm super excited to talk to you because you're sort of an anecdote of a couple of trends that are playing out now in both angel investing and venture. You operate remotely in a sense that you operate from Jakarta, but you invest in companies across the world, and you're also an operator investor because you also run your own company in health tech space. So that makes me excited following your investing for a while as well to have this conversation. But before getting into the angel investing and venture investing side of it, if you can tell me about your career before angel investing and how did you get into angel investing itself?
Sure. So my background has been with banking and finance, which took me to all over the world, from Asia to Africa, almost 9 countries later. Last was in Indonesia. And from banking, then I left banking and moved to healthcare and worked on setting up a digital healthcare business, essentially providing people access to healthcare who otherwise won't have it. So it started as a digital healthcare, then we brought in a health financing component because many countries in the emerging markets don't have a proper health insurance or strong health financing infrastructure. And from there, it expanded to offline proposition like clinics, hospital, medical college, nursing college, etc. So essentially trying to create a healthcare ecosystem. That's one of the operator role that I'm doing now.
And at what point did you start investing into startups?
So it happened, during when I was in banking days. A few founders reached out to me. They were trying to build comparison sites, and they reached out to me in Indonesia, where I was located at that point of time, and asked me whether I can help them, advise them through the regulatory landscape. So that was my first sort of like involvement in a startup company, and then they were trying to raise a small round where I invested along with other investors, personal checks. So that sort of started my investment journey. That was sort of, in a way, it's an accidental investor, so to speak. And of course, from that time on, the other people on the cap table, they really wanted me to, showed me the way to how to invest in other companies, guide me to different, processes, methods, etc. And so that was the rabbit hole I went into, and I'm still there.
And you went in the rabbit hole pretty deeply, right? Because I think you're one of the few persons who can say who has seen like 40 plus exits, if I'm right.
Yeah. I mean, so yeah. Once I went into it, it was really going full heads on. So I ended up investing almost 1,000 or so companies over the years. So I'm doing this for the last it started around 2014, so roughly 7 years or so now, and 1,000 plus companies.
Are you the highest, are you the investor with highest number of angel investments?
I don't know. Maybe. I mean, if not the highest, it would probably be one of the top ones. I mean, I have seen people who have invested, 400 or 500 or so. So I don't know. Maybe one of
the only one at least in my research, is close to it is probably Novel, or someone who has run multiple seed funds, which I haven't come across. But I think you probably might be at the number 1 or 2 position, at least in terms of as a syndicate, you might probably be the highest, if I'm not wrong. You might know better, but at least that's my interpretation as an outsider. So when you first started angel investing, one of the, and correct me if I'm wrong, you started doing it through AngelList, right?
So the first one, obviously, first few investments were direct investment, my personal checks into the company. And at that time, then I slowly got to know about AngelList and Funders Club, WeFunder, different platforms out there. So then I started mostly through AngelList, but also a few through other platforms. But I would say my investments in syndicates or other, that sort of platform would be 80% AngelInvest and 20% the other.
Having built, and done investments through MyAsia VC, which is your major way of investing. One of the things I personally see is there's a cold start problem, right? Initially, when you're trying to get things off the ground, you're almost like a marketplace for LPs and startups. And if you don't have enough LPs, you can't comfortably say yes to the startups that you want to invest in. And if you don't have good startups, you don't have LPs coming in subscribing to your syndicate. So how did you solve that problem initially when you're getting started?
Yes, so it's you rightly pointed out, it's a very interesting situation. So so my syndicate is roughly a little over a year old, right? So before that, I was investing on my own or through other syndicates. And when I started this syndicate, my first deal was a YC company. It so happened that I came across this YC company where I personally invested. And then the company also wanted to raise more funds. And I approached to one other syndicate lead whether he would be interested to lead the deal. He had other deals on his plate, so he said he doesn't have the bandwidth, and then I said, okay, let me try on my own. So that was my first syndicate. Luckily, the syndicate did well. It got distributed to a wider network on AngelList, and at that time I didn't have I don't recall, but I probably had 50, 100 LPs, so it was not a big LP base. But anyway, so because the deal got quite a bit of exposure, other LPs started joining, and then of course it started creating a virtuous cycle, like you're mentioning, because more LPs joining, better deal coming through, more LPs joining, right? So then the virtuous cycle started.
Got it. What do you think? If someone is trying to crack this culture problem today, because obviously it's a very competitive landscape in terms of the whole syndicate model. You then have rolling funds, roll-up vehicles, and just outside platforms. For someone who's starting today and who's looking at a syndicate deal, how would you suggest them to go about it?
I would suggest first, of course, source a strong deal. And no one would expect the person to have a strong LP base to start with.
Mm-hmm.
So one option would be to co-syndicate the deal. So essentially, reach out to other leads who has probably a much larger following or LP base, so to co-syndicate. And that way, so essentially the way the co-syndicate works is that, for example, let's say X brings me a deal. I lead the syndicate under my syndicate, but I refer that this deal is brought by X. So X then gets an exposure to my LP base, and some of the LPs will start following X syndicate. And that way, if he does a couple of deals like that with other syndicate leads, he will start gaining sort of like a 50, 100, 200, 300 LP base. Yeah. And once it reaches a certain, let's say 300, 400 LP base, then he can start launching his own deal. So that's roughly how I would suggest anyone new to enter the space.
Yeah, that's how I did my first investment as well. I co-syndicated with someone that I knew very well before and has been following. Yeah, I think you're on point, because I think the people who are otherwise successful are people who have large, either Twitter following. I think Sahil, who does a successful rolling fund. If you have a separate clout altogether individually, being an entrepreneur or an investor outside, I think then you're also a good candidate to start. But otherwise, if you don't have that sort of a clout, I think this is the best way. So moving on from like most like early successful leads, right? Like Jason Calacanis or Zach, who did the cruise deal for which was acquired by GM. Most often you see them graduating to do funds, right? Jason moved out of the platform and famously runs the most largest syndicate, or at least he says, we don't know if it is the most largest. And Zach also does his syndicate, but also runs his own fund. Are you also looking to graduate beyond what you're doing with MyAsia, or do you have plans, or you're okay with playing in this pre-seed seed stage where you are doing it primarily through the syndicate as a vehicle?
I mean, I noticed that trend before. So what used to happen is, like I mentioned, Jason and Zach and a few others I've seen, they started with the syndicate model. But after some time, they found, either went off AngelList platform, and of course, have their own funds, because fund has many advantages compared to Syndicate. But what I'm seeing nowadays is that a lot of people are actually continuing Syndicate as well as the rolling fund that AngelList launched. So I personally, there are pluses and minuses with both the approaches. I have a small rolling fund now. As well as I'm working on launching another fund, which would mostly focus on secondaries. So we can cover that later. But I think I will continue to use the syndicate model, because there are some very interesting advantages with syndicate model compared to a fund. So I don't see myself completely moving off the syndicate model or off AngelList platform. I think that will continue, but I will have the funds on the side. If you want me to elaborate on the syndicate thing, I think one of the big advantages of doing a syndicate compared to a fund is that fund has to have a very specific thesis, right? So let's say you want to invest in, let's say, fintech companies in emerging markets, in seed stage. So you can define your thesis of the fund, and then you raise LP money accordingly and you invest. In case of syndicate, the lead is relatively free, sort of like a relatively free-handed, in the sense that I can bring any deal that I like and which I think is a good investment. It may be in health tech space, it may be in space, it may be in US, it may be in Brazil. So the scope of the syndicate is much larger in terms of sourcing deals or bringing interesting deals. So I think syndicate would always be, for me personally at least, would be a good way to invest in future.
Got it. I'm also curious about how do you think about rolling funds, because one of the criticisms for rolling funds I see and keep hearing is what happens, let's say I subscribe to your rolling fund, but I missed that one particular quarter where, all the two unicorns that your rolling fund actually invested in. And we know that, this, venture is a game of power law, and, it's your ability to find the next Facebook or next Twitter, or the next maybe Coinbase or Airbnb is basically defining your success. At least that's the view, or that's the view that is promoted. So how do you counter this argument when, as someone who actually is running a rolling fund?
Oh, true. That's the risk, or that's the sort of the downside. Every model has its pluses and minuses. So rolling fund compared to traditional funds has many advantages in terms of LP commitment, first investment of funds. So it doesn't have to wait for a closing and all those stuff. But of course, then you run the risk of if an LP does not subscribe to every quarter, let's say for next. So hypothetically, let's say I launched my rolling fund 2 quarters back. Now, if, in the next 8 quarters, I might, I don't know, in one particular quarter, I might hit, one unicorn, and some LP probably decided to invest in 4 quarters and then didn't continue, right? So that happened. If you think of a fund, I think the only thing about fund is that because it's a wider time frame, i.e., a fund usually typically invests over 3 years and then have some money left for pro rata. Compared to that, so once you commit to that fund, you essentially are covered for 3 years investment of that fund. Whereas if you commit to a rolling fund, you're essentially, covered for 1 quarter, assuming you go quarter by quarter. Right? So I guess that's where the probability kicks in, right? In a fund, you can say that okay, fund 1 has 1 unicorn, fund 2 had 5 unicorns. I probably should have invested in fund 2. You can use that logic, but again, because of the wider time frame, I guess fund has a higher probability to hit that, 1 or 2 unicorns in a portfolio, right? So yeah, it's a question of, as an LP, I think the strategy then should be that if you really believe in the lead, then continue to, because the amount can be very small compared to a fund commitment. So, the LP should continue to, invest every quarter of that rolling fund. That's where the probability goes up.
Yeah, it's essentially for the LP to decide, whether he wants to continue at what time frame they want to invest in. I think that it comes down to essentially choosing the right time frame, whether to be involved in a fund or, a rolling fund or a roll-up vehicle. So you also mentioned you're looking into a fund for secondaries, which is interesting because I think you're one of the few people who also go into different stages of investments, right? Like you start from pre-seed, seed, and you also do secondaries pre-IPO as well. So how do you think in general which stage you're investing in? What is the decision process at that point is like when you're looking
Yeah,
at a seed
yeah.
opportunity versus something like a secondary opportunity, and why have you even decided to do a secondary fund?
So, so two things on the, that's probably, one of the advantages of a syndicate. So for example, right now I have, a very large LP base, like over 2000 plus, so probably one of the largest out there. And, because it's an opt-in method. So let's say I launch a deal, which is a pre-seed or seed stage. And of that large LP base, 15, 20 people or 30 people will actually like that stage and will invest in. But then if I launch a secondary deal, which is probably, let's say, hypothetically a $5 billion company, which may go to public in the next 1-2 years, then there is another group of people within that large LP base who prefer to invest in later stage, given the relative strength of the company, relative security of an exit and stuff like that, right? So, so syndicate that way gives me that that freedom to source different deals. In terms of the secondary, the reason I actually started it a couple of months back, so it's not very old, but the reason I started it is, I'm seeing a lot of the companies which are in a very sweet spot. So for example, let's say they are, let's say a $1 billion company, which has very strong traction. And there is another company sort of in the same space, which probably went to IPO at, let's say, 20 billion. Now, the first company, which is $1 billion, there's all probability given the traction they have that they will reach probably 5 billion or 10 billion as they go into public. So, here the risk is significantly reduced. The company is in a very strong growth trajectory, and we have a chance of doing 4-5x even from this point, which is from an IRR perspective, that's going quite significant. So yeah, and we are seeing a lot of these because some of the companies are taking longer to go to public, or some of the companies, are seeing traction too early. So we are seeing a lot of the early investors in those companies are actually ready to do some secondary to get some liquidity. And that's why, I thought I should do it. So I did a couple of syndicates, which have done quite well. And then some of the LPs reached out to me and asked, why don't you do a fund so that they don't have to go deal by deal, but actually carry on a total fund level. So I said, okay, fine. So then, I'm now working on launching the fund. And once it's done, it will specifically focus on secondary deals. So the fund has a very clear thesis, which is invest in secondary deals, companies which are expected to go to public or exit in next 2 years, 2 to 3 years max. So the fund, unlike a typical 8 to 10 years fund, this would be a fund which is where the life cycle would be 3 to 5 years max. Yeah.
It's also, I think, another thing that we see that is playing into this is whatever we imagine internet businesses market sizes will be, they're absolutely, we are actually, limited by our imagination. They're much more larger. Like, for example, recently when Airbnb went IPO, everyone's talking about even if you have invested at $1 billion valuation, you would have still made a 20x or 25x returns on that investment. So I think you're definitely right, and I've been noticing the same as well in terms of later stage investments. But how do you compare that with what the mega funds are doing into going into early stages? Right now, we are seeing Tiger, especially in India, is going at seed level. You have Softbank also, which is going at, I think, Series A, Series B level. How do you see this larger funds, moving back into pre-seed, seed, while, as you rightly pointed out, there's a sweet spot at, getting later stage deals?
So I guess you could give another anecdote. So, someone offered me to invest at Coinbase at 1 billion, and I thought, how big can this be? So obviously I missed that one. Yeah, but I think the point about Softbank or Tiger, I think their problem is a bit different, right? So they have a very strong deal flow at late stage, given the size of the fund and everything, and they now want to enter very early at the 6th stage to start taking stakes on most promising companies, right? So it's for them, it's more like a deal flow for their later stage investment. So taking a bet on 6th stage, give them a very good view of the company. They can continue to increase the stake as the company grows if they feel like it, and then of course write a much larger check at the later stage. So for those guys, it's more about getting a strong deal flow, so that, let's say, hypothetically, Softbank doesn't want Sequoia to come in and scoop those late stage deals, right? So they want to get into that. So for them, the strategy is essentially to ensure the deal flow. And of course, if you do a seed stage investment and that turns out to be a Coinbase or Uber, then the return is significantly higher than doing a late stage deal. Right? So
yeah,
so that analysis is there.
I was as I was researching for this conversation, I think you're only or probably a second person who said startup investing is not risky. It's almost counterintuitive to what we hear in general in public. Obviously, venture in general is pitched as the most riskiest asset class, right? Why do you, and how do you, what is your framework around, assessing risk in early stage investing? And because often we hear investing in startups is the most riskiest thing you could do. Why do you think the opposite? Because I think you said in one of the conversations, startup investing is actually not risky.
Yeah, I personally think it's not as risky as it's pointed out to be. Compared to that, there are many investments which are riskier. So so the startup investment typically suffers from illiquidity, right? So you don't get the liquidity as quickly as you want. You're sort of stuck with the company, and of course, we know many companies fail, so there is always that risk of completely losing the capital and stuff. But what I've seen at a portfolio basis, startup investments are significantly more rewarding compared to typical investments like on public stocks and others. So the important thing would be to obviously follow a portfolio approach. So not invest in one or two, but do a good portfolio approach of 20, 30, 50 companies. The fact that the point we were discussing before, that we tend to underestimate the market size of internet companies, and this is only going to grow larger. What we are seeing today, there's all probability that this particular sector will continue to do 10x in every 10 years, or maybe 10x in every 5 years. So this is going to grow rapidly. It's more about the investing in the future than investing in the past. And I think startup investments, especially technology startups, are sort of like investing in the future, which is sort of where the real return comes in. So, we tend to follow the investments, like real estate investment and others, which is sort of like a fast-looking investment. But when you're thinking of the future of all these satellite companies, space companies, DNA editing companies, or even in the SaaS space, B2B enterprise SaaS and everything. So these are all forward-looking companies where I think the market is so huge that even in a portfolio of 50 companies, if one or two strikes out well, then the return will be significantly higher than investing in a real estate and others. So that way, I think it's not a risky investment compared to other options. So as long as one can stomach the illiquid nature of the investment, I think this is a very good way to create wealth.
Also, what do you think about the change in liquidity? Because I think we are seeing more and more, secondary platforms that are coming and facilitating secondary transactions, and even you investing in secondary as part of your fund is almost a liquidity event for someone who's investing in a pre-seed or writing that first angel check, right? How are you seeing that change? Because at least in my perspective, I think we are seeing a little bit more liquidity than at least 5 years back.
Oh yeah, definitely. And I think that will continue. It won't be so. For example, the secondary will essentially happen if the company has reached, hypothetically, let's say Series C, Series D, or $500 million or $1 billion valuation. So someone investing in pre-seed or seed, let's say 5-10 million valuation, will probably still have to wait 3-4 years to reach there, or 5 years. But it's not the typical 10 years that we usually think with startups. Nowadays, there are a lot of focus on secondaries or giving liquidity to founders or early investors. In fact, I invested in a couple of companies personally as my direct investment, and we are already seeing, some of those companies have reached unicorn, and then we are already seeing tender offers as they reach the large round. There are already tender offers for early investors to sell a part of their shares. So that is becoming a common theme for startups, which has done very well, and there's so to provide liquidity at least to 15-20% of the stake for these companies and investors. So I think those would be coming in more and more, and we'll see this practice more widespread across countries. That trend will continue.
I think one of the things you mentioned obviously is investing across the globe, right? How are you looking at investing across the globe? Because it's always interesting when at least from my personal experience, to invest in, let's say, African companies where I don't know anything about. I obviously can look into India and US and make a decision. But how is your decision process? And also another question around decision making is you're obviously doing a lot more than what a typical investor does. Let's say an LP in your fund, right? You are making many more decisions. What is your decision process in general like?
So two things. One is as someone who has been to many of these countries. So I spent 5 years in Africa. Many countries in Asia and others. So one of the things, sort of like one of the vantage point that I have is going across all these countries. And I'm a firm believer that all these countries are on the same curve, but at different points. Right? So where US was probably 30 years back, or China or India, Africa or Latin countries are probably 10 years back, or will be there in 10 years time. So it's sort of like investing in early days in some of these large companies in India or in China or US. So we are sort of seeing those companies because one of the things that you notice across these geographies is that the idea is not very different, right? So you see, you have Uber, you have Uber's version of Gojek, Grab in Southeast Asia. Interesting. Each of these companies are now $30-40 billion, or you have Amazon, you have Tokopedia, Bukalapak, right? So you have different versions of these companies. So it's not like they are trying to do something very unique. It's more about the business model might have been tweaked a bit. So for example, Gojek had their motorcycle rather than car, as the main transport. So so you may have seen some of the tweak in modular product, but essentially it's not very different. So so there's hardly a business model risk. It's more of the execution risk for this country, for these companies across geographies. And I am seeing actually some fund built around the thesis that they are looking for companies which are essentially implementing the same model of their, let's say, much larger counterpart in the US, but has traction. So we are seeing funds investing just in those companies from the frontier markets, because it's sort of like early days of investing in Amazon. It's sort of like early days of investing in Uber. That these companies, if they succeed, they'll be really big. And we have an opportunity we know the playbook because we know how it has happened before. So you can exactly know where this is going. And I find that very exciting and interesting to invest. And that's one of the reasons, I do a lot of deals. So probably what is sort of unique in my syndicate is that compared to others, I do a lot of deals outside US. So my deals would probably be 60% in US, 40% be outside US across all these markets, showing the same sort of trajectory in the growth. So I think that's quite interesting.
How long generally you take to decide whether or not you're going to invest?
So on the due diligence part, what I do is, so I have a sort of like a questionnaire that I follow myself. So usually it depends on the, first of all, there's this introductory call where I talk with the founders and decide, whether to do it or not. So if it's a no, then, that's usually an upfront no, because, so let's after talking with the founder 15, 20, 30 minutes, I feel like, okay, this is not going to work, or it's not an ideal candidate for the syndicate, then, that's an upfront no. But then there are two groups of companies where I'm very convinced that, okay, like you talk with the founder 30, 40 minutes, so you see the traction, you think, you see the other names of the captive, and you're very convinced it's going to be strict, and then of course, then I send them the due diligence questionnaires. Once they fill up the due diligence questionnaires, then I go through, some other, back-end, due diligence, and then I launch the deal. So those would be very fast track. Those I'm very convinced about. But then there are some in between, right, in the gray, where I'm convinced, but I'm not super confident. So those are the ones which I take a bit of time. And then I want to follow the company for a while and tell the founder to keep me updated as they progress their funding round and see who else is coming in and what is the traction looking like. And then if I'm convinced, then I bring those deals. So one is upfront yes, and one is upfront no, so to speak. And then there's a big middle, which I take time to do deeper, due diligence. So that's sort of the three buckets.
Got it. And in terms of the other sectors that is obviously very much blowing up is sort of all the crypto companies that are coming up. I guess we might not even call them companies because some of them don't even have company registrations behind them. How are you looking at investing in crypto, and what areas are you looking at specifically?
So yeah, so there are a couple of things in terms of. So I'm doing a few late stage deals. So in terms of exchanges, because I think exchanges are very interesting. They have a huge cash flow. They of course have to go through the regulatory compliance and risk, manage the risk associated with the exchanges in terms of licensing and others. But from a cash flow basis, these are very good businesses, and we saw that reflected in Coinbase's valuation. And we know that Kraken and others are on the same trajectory. So I think exchanges are very interesting businesses. And then, of course, there are companies which are into, so there's one company which is trying to replicate X Infinity, so gaming space on blockchain. So those would be interesting. Of course, NFT is a big theme now, so anything on the NFT would be interesting. But of course, like you're saying, I talk with companies where they don't even have a registration. So, that I tell them, okay, first you have to register a company, otherwise we can't invest in all this stuff. So, yeah, so it's a bit of a wild west out there. Coming across through the right company takes time, but I think it can be very rewarding, because what is very interesting about a lot of the fundraise of these companies, they use what they call SAFT. So it's a equity which can be turned into a token in future. And then, of course, then the liquidity game changes completely, right? So the typical stub investment where you are holding, equity, maybe 6, 7, 8 years, 5 years. In case of token, you may get the liquidity within 2, 3 years or earlier, right? So
yes.
So the liquidity formula changes significantly. But of course, AngelList has some strict regulations on what can be, syndicated there. So we have to follow all those, given the risk associated with all this, and regulatory risk essentially associated with these companies.
And can you bring to a syndicate a company which doesn't have a registration, or does AngelList require a registration?
Yeah.
Got it.
No, you need a basic legal structure. Yeah.
Got it. But we're still seeing some really tier 1 names involved in some of these companies without registration. What do you think about that?
I don't know how they're doing it, because you'd assume that if let's say X fund is investing in a company without a legal structure, I don't know how they even issue the documents, right? So that's that I'm not very clear, but I obviously those are very risky options for any fund to do. So yeah, I have talked with a couple of companies who claimed that they have X or Y investors, and then when I asked them, okay, can you send me your incorporation details? They said we are working on it. So I don't know how those guys are doing it, but that would be interesting.
Got it. And we're almost at the end of our conversation, and I want to know what you're most excited to see in next couple of years in terms of investing.
So I'm a big believer of a couple of trends. One is the whole space, the companies that are built around space economy. So I think that would be quite interesting. Then of course on the biotech space, the whole CRISPR. There's a lot of companies coming out. Even if you've seen YC, there are a lot of companies coming out in biotech space. Some of those are very interesting and very accomplished founders. So it would be interesting to see some breakthroughs there. So that's the other one. And then, of course, I'm always interested to see some companies in frontier markets of Africa, Asia, Latam to really make it big. It gives additional pleasure, because that you are supporting a company which is not the typical Silicon Valley one, and really made it big. So so that really gives a lot of pleasure as an investor to see those breakthroughs. Because what happens in a lot of these countries is that once you have 1 or 2 large exits, that creates a whole ecosystem within the country, right? So if if a country has their first $1 billion exits, then that company generates a lot of wealth within the team. Those guys then go out, build their own companies or invest in other companies in that startup ecosystem. So it is a very nice virtuous effect to the startup ecosystem of that particular country. So so it's always quite exciting to see these companies from the countries which are usually ignored to make it big.
Yeah, you're absolutely right. I think we've seen that with Flipkart in India, and that sort of triggered the next level of cycle that we are seeing today, and even other economies as well. Thanks, Sajid. Thanks for being on the show and taking time. And looking forward for more investments from Asia VC.
Thanks, Nataraj. It was a pleasure. We really enjoyed the conversation.